Welcome to the deep dive. Today we're tackling a big pile of sources, articles, market reports, internal notes, really digging into one specific area, the Mont Kiara property market.
Yeah, and specifically, we're focusing on what's coming next, the upcoming developments set to hit the scene.
Exactly. So our job today is to sift through all this information, pull out the really crucial bits, and help you figure out what matters most, whether you're maybe looking to invest or perhaps find a place to live yourself.
Think of us as guides cutting through the noise, basically, helping you see the forest for the trees.
Absolutely, because Mont Kiara, well, anyone familiar with KL property knows it's not just another neighborhood, right?
Not at all. It's like its own little world, a really distinct, high-status submarket.
Yeah.
It's been the place for expats and well-off Malaysians for, well, decades now.
Built on a unique ecosystem.
And what's really interesting, I think, is this kind of core tension, this duality driving demand.
Okay.
On one hand, you've got investors. They're looking at rental returns, capital growth potential, pure financials mostly.
Right.
And on the other hand, you have residents. They're thinking lifestyle, convenience, safety, community feel.
And those two things don't always pull in the same direction.
Exactly. Like developers might want higher density for more units, which helps the investment numbers, but that can clash with a resident wanting more space, more privacy. That tension really shapes the whole market.
So let's break down why Mont Kiara holds that premium status. What are the fundamental drivers keeping people interested?
Well, the absolute bedrock, you could say, is its pull for expats. It's a magnet.
The international schools, mainly.
That's a huge part of it. You've got Garden International and PIS, the French school, all top tier. This guarantees a steady flow of, good quality tenants, often with corporate budgets behind them. That's crucial for the rental market.
Makes sense. And it's not just the schools, is it? It's the whole setup there.
People call it a bubble of convenience, and honestly, it kind of is.
Yeah.
You can walk to so much. Retail like 163, One Mont Kiara, Plaza Mont Kiara, or Chorus. Tons of food options, healthcare, like global doctors right there. It's that everything you need is just outside your door kind of lifestyle.
And that convenience definitely commands a premium price.
It does. And then there's the other side, the less tangible bit.
The prestige factor.
Yeah, the social currency. Having a Mont Kiara address means something. It signals affluence, so it attracts local upgraders, high net worth folks too. Adds another layer of demand.
Okay, so powerful demand drivers, a whole ecosystem. But the sources we looked at were also pretty blunt about the challenges, the friction points. What are the main ones?
I'd say the biggest one is hyper-competition, almost saturation.
Right. Just so many condos packed in.
Exactly. Decades of development have led to this extremely dense condo population. And if you look at rentals, especially, say, in that RM 6K to 9K range, our sources suggest there are over 1,300 units actively competing right now.
Wow. That's a lot.
It makes for a fiercely competitive rental market. Landlords find it really hard to push rents up, and the risk of vacancies is higher. So any property, new or old, really needs something unique, a USP, just to stand out from the crowd.
And traffic is always mentioned. A nightmare, basically.
It's a significant downside for quality of life, no doubt. The entry and exit points just aren't enough, especially at peak times. It bottlenecks badly.
And the construction. It never seems to stop there.
That's the construction fatigue factor. It's kind of the price you pay for living in an evolving area, I suppose. Constant noise, dust, trucks. It's just part of the background reality for residents, often for years.
Okay, let's pull back for a sec. What's the bigger picture? How's the Malaysian economy and the national property market looking as we head into, say, 2025?
Well, the overall economy seems to be cautiously optimistic, seeing signs of stabilization. GDP growth forecasts are looking decent, maybe 4.5 to 5.5% for 2025. Inflation seems under control, so the general backdrop is, supportive.
And the property market nationwide?
The term used in the sources was measured calibration. Basically, after a long run of growth, Q1 2025 saw a bit of a dip in sales volume and value.
Okay, so buyers taking a pause nationally?
For actual consumer transactions, yeah, things cooled a bit. And this is really key developer activity. It's described as robust.
Oh, interesting. So they're still building?
Very much so.
Yeah.
Units under construction were up something like 32% year-on-year in Q1. New project launches actually doubled.
Huh. So developers are confident, but does that mean there's a risk of too much supply?
That's exactly the risk. It signals developer confidence, yes. But if consumer demand doesn't pick up pace to match all this new stock coming online, you could definitely see an oversupply situation developing.
Which brings us right back to Mont Kiara specifically. Let's dive into the numbers there. What did the data tell us?
Okay, looking at early 2025 figures, the median transacted price was hovering around RM 1.3 million.
And per square foot.
Median PSF price per square foot was about RM 731. Now, that PSF figure showed modest growth year on year, about 3.17%.
Okay, 3% growth. That sounds okay.
On the surface, maybe,
Yeah.
but you need to dig a bit deeper. There's a crucial pattern.
Right.
Data from LEAP 2024, looking specifically at typical two-bedroom high-rises, average rents went up maybe 3.3%, but average prices for those same kinds of units only up 0.6%.
Ah, so rents grew much faster than prices for existing units.
Precisely. And that matches what we hear anecdotally, that capital appreciation for standard secondary market condos has been pretty flat, minimal really, for the last 5 years or so.
So that overall 3% median PSF growth we mentioned, where's that coming from? Is it skewed?
Exactly. It's heavily influenced by sales in the newer, more premium projects. Think Residency 22 hitting close to RM 1100 PSF or Cortis over RM 1000. Those pull the average up.
Right.
Your average older condo isn't seeing that kind of capital gain. So the big takeaway here, and this is critical if you're thinking of buying, don't just assume the whole market is rising together. General appreciation isn't guaranteed anymore. If you're looking for capital gains, your success really hinges on picking the right project, something with features the market values, something that can command good rent over time.
That really shifts the perspective. It's not just about buying in Mont Kiara, it's about buying the right asset within Mont Kiara. Okay, let's talk about the investment maths then. Yield versus appreciation, and crucially, the costs.
Right. So Mont Kiara often looks better on gross yield compared to, say, KLCC or Bangsar. National average gross yield was around 5.1% in Q1 2025.
But gross isn't what ends up in your pocket.
Exactly. You absolutely have to look at the net yield. Once you subtract maintenance fees, taxes, agent fees, maybe some empty periods, you're realistically looking at more like 3%, maybe 4% net yield.
And that fierce rental competition we talked about, those 1,300 plus units, must make it hard to raise rents.
It puts a real cap on pricing power. Unless your unit has something genuinely special, it's tough to push rents higher. Often the rental income really just covers your running costs, maybe your mortgage payments.
So the profit really depends on selling it for more later.
For many investors, yes, the profit relies heavily on capital gain when they eventually sell, which again puts huge emphasis on choosing the right project initially.
What about other big costs, maintenance fees?
They're substantial, especially in these high-end buildings with pools, gyms, security. You could be looking at RM 0.35 to RM 0.50 per square foot per month. For a decent-sized 2,000 Seskioff place, that's RM 700 to RM 1,000 a month, every month.
Ouch. Tenant or no tenant?
Right. And don't forget RPGT, real property gains tax. That's a tax on your profit when you sell. And the rates are higher if you sell within the first 5 years.
Okay, so summing up for an investor, you're essentially buying access to that desirable tenant pool expats, affluent locals. But the real financial win likely comes from capital appreciation down the line.
And that appreciation isn't automatic across the board.
It's project-specific. Depends on picking a winner with strong, defensible, unique selling points.
That's the absolute core insight from all the sources, yeah.
All right. So given this landscape, high demand, yes, but also intense competition and this uneven appreciation, developers really need to be smart. They need to differentiate.